I predicted all recent down movements in the S&P 500. Let's go get some fresh air after such a bold statement. And besides, it's always a good idea, whenever possible, during these challenging times. I was asked to clarify and elaborate on what sensitivity and specificity are, especially after my video about credit analyst prediction bias. If you're trying to win a game at securities trading by timing the market using an ETF on the S&P 500, chances are you are attempting to predict up and down movements on the market. Let's say you're mostly but not only concerned with down movements on the market. You try and predict down movements on the market without sacrificing the potential for upward movements by taking on the risk of getting the timing wrong when choosing when to buy and when to sell. What are sensitivity and specificity? Why do we see them listed in all major forecast model outputs? Let's try and find out. Let's go back to my studio. How good am I in forecasting down movements on the S&P 500? Let's make an example considering that most forecasts come in the shape of binary predictions, like will it be high or low? Will it be green or red? Will it be yes or no? Will it be up or down? We want to measure how good we are in forecasting down movements on the S&P 500. We basically would like to dodge negative returns so as to make a lot of money investing only when the market goes up. Let's consider this imaginary example where I made my predictions on the S&P 500 as simple ups or downs forecasts on a daily basis. I correctly forecast Monday, Thursday, and Friday. But since we said we're mostly concerned with down movements, that is, we're trying to avoid losses, we will isolate my downswing predictions only. I predicted a downswing on Monday, Wednesday, and Friday. I got it right only on Monday and Friday when I predicted a down movement and the market actually went down. But on Wednesday, when I predicted a downswing, the market went up. This is an error. If we now focus on the opposite side of our prediction algorithm, up movements, we will neglect no movements for the sake of simplicity and because of the fact that no movements are pretty unlikely to occur. We now see that we didn't predict a down movement on Tuesday and on Thursday. That is, we can say we forecast an upswing and we were mistaken on Tuesday, when in fact the market went down. That is an error. We can then try and intersect our predictions with the actual movements on the S&P 500 by summarizing them in a double entry table, as shown in this example, where actual and predicted outcomes are organized by column and row respectively. I forecast 3 downswings, but only got 2 right. That is, I correctly predicted a down movement 2 out of 3. The ratio of 2 correctly specified predictions to the actual total number of such instances, 3, is what we call sensitivity. That is, we were right in predicting down movements 0.67 or 67% of the times. If we now look at the other side of our prediction model, up movements, we can see that whilst I predicted 2 up movements, only 1 was correctly specified. It was on Thursday, whereas I mistakenly forecast an up movement on Tuesday. The ratio of the correctly specified upswings to the actual total number of such occurrences is called specificity, and in this case it's 0.5 or 50%. To recap our example, we have sensitivity and specificity to be 67% and 50% respectively. What does this mean in practical terms? Why do we need two statistics here to assess whether our prediction formula is good or not? It looks as though there are two sides to a binary prediction, a bright side and a dark side. Sensitivity measures the ability of an algorithm, a trading system, a wizard, if you will, to identify what we are trying to predict. In this case, down movements on the S&P 500. But our ability to forecast, in this case, downswings on the S&P 500, is closely related to that of not missing up movements. You see, I said the ability not to miss up movements is how I characterize the problem this time. Because in fact, I try and predict down movements in practical terms, and I stress practical terms. If I always predicted a down movement, I would be 100% of the times correct, but only when it comes to down movements. In fact, I would have predicted all 3 down movements. 3 out of 3. Sensitivity would have been 100%. I correctly predicted all down movements on the S&P 500. Great! It'd be like forecasting bad weather every day. I'd hit the bullseye every time it rains. But would that be useful? Would that make sense? Besides, I would have missed all up movements. In this case, specificity would have been 0%. Ideally, we want both sensitivity and specificity to be as high as possible. In a low validity environment, like the daily returns on an equity index, predictive accuracy is seldom high. You see, I used another term, accuracy. Accuracy is another metric that comprehensively assesses how good a binary prediction is that has to be supplemented with sensitivity and specificity. Accuracy, which could be the material for another video, informs us on how good we are in detecting both up and down signals. Ever heard market commentators claiming they were right 100% of the time in predicting down movements, crashes, bear markets, market rallies, up movements? Have they computed their own statistics? Have they calculated sensitivity and specificity? Or are they just frauds or quacks? Or have they selectively chosen the occurrences when they correctly predicted down movements on the S&P 500, for example? Have they shared only those with us? Sensitivity and specificity are key performance indicators of diagnostic tests, for example. And they've become popular during the current epidemic in relation to COVID tests, where the ability to spot a positive case, an infection, is measured by sensitivity, whereas the ability to identify a negative case or a non-infected person is measured by specificity. A binary prediction formula's performance, such as a COVID test, is measured in relation to its ability to perform in isolating positive cases with the disease from negative cases without the disease. In our case, we were testing whether our formula had the desired predictive power to allow us to rely on it. It would be useless to have a predictive algorithm that tells us every day the market will crash. It'll be 100% of the times correct in predicting down movements, but it would be completely useless because it would be no specific. To sum it all up, for a binary forecast, like as we used up or down, high and low, green or red, two statistics tell us how good our algorithm, formula, or crystal sphere. Sensitivity and specificity, which respectively inform us on how good it performs with what we're trying to predict, and its complementary opposite, are an integral part of any binary forecasting model aiming at detecting signals for buying and selling securities. Getting back to our initial example, We have 5 market movements we want to forecast in relation to 2 possible changes, up or down, and we classify them by binning them into 2 classes. After our prediction model has given our output, the classification will look like this. So, since we're trying to forecast down movements, we first focus on how good we've been at this by calculating sensitivity, which in our case is 67%. That is, 2 out of 3 cases have been correctly forecast. We've correctly classified as down movements 2 occurrences. The opposite side of a down movement is an up movement, and we've correctly classified 1 out of 2 upswings, which brings in specificity at 50%. One can think of sensitivity and specificity as the ability to correctly bin cases into their respective classes where they belong to. If we had a perfect prediction foresight, our binning would look like this, and we would have 100% sensitivity and 100% specificity. Now, bear with me one more time. Let's get back to our naive predictive model of constantly forecasting a down movement each day. Sensitivity would be again 100%, though specificity would be 0%. So you can think of sensitivity and specificity as the ability to correctly bin binary future events into 2 categories. If we had perfect foresight, it wouldn't be a problem to bring those 2 statistics to 100%. Beware of false predictors, because the reality of predicting up and down movements on an equity index is much more difficult. Next time you see a video or an advertisement promising stellar returns, go and get some fresh air. This is a prediction algorithm, and this is a violin. Not bad for